Now we're going to look in greater detail at those transactions that determine the supply and demand for currency, that determine the exchange rate. We'll discuss the balance of payments, including the nature of transactions that enter the balance of payments, as well as the relationship between categories of transactions in the balance of payments. First, let's just define the balance of payments. The balance of payments is simply the accounting record of the inflows and outflows of a nation with respect to the rest of the world. These inflows and outflows are generated by trade in goods and services and purchases of financial assets. For example, exports from the United States to other nations produces an inflow to the United States as other nations pay for those exports. Imports of the United States from the rest of the world produces an outflow as people in the U.S. pay for imports from the rest of the world. Similarly, exchanges of financial assets are going to produce inflows and outflows. Transactions that produce an inflow are known as credit transactions, and they carry a positive sign. Transactions that produce an outflow are known as debit transactions and carry a negative sign. Now let's consider the current account, a subsection of the balance of payments. The exports and imports in goods and services are called current account transactions because they represent the purchase and sale of goods and services produced in the current period. Also included in the current account are earnings on assets. Assets held abroad produce an inflow of earnings to residents of the United States, and assets from the United States held abroad produce an outflow of earnings to those residents abroad. In addition to earnings on assets, included in the current account, private gifts made to foreigners and received from foreigners are also included in the current account. Now let's consider the financial account. The movement of funds due to the purchase and sale of financial assets are called financial account transactions. For example, if a British citizen buys a U.S. Treasury bill, then funds flow to the United States. The U.S. is borrowing and Britain is lending. If the British citizen subsequently sells the U.S. Treasury bill, then that is a reduction in lending, and that is an outflow of funds from the United States. Similarly, when U.S. citizens buy assets abroad, that produces an outflow of funds from the United States. Also included in financial account transactions are the purchase and sale of stocks. If the purchase of stocks are large enough to represent a controlling interest, usually defined as 10% or more, then that form of investment is called direct investment. Smaller purchases of assets are called portfolio investment. An important relationship in the balance of payments is that any flow of funds is going to be matched by an equal and opposite flow of funds. As an example, suppose a U.S. importer buys goods from France and acquires the euros to buy the goods from a French bank. The import is an outflow of funds, but if the French bank then uses the dollars that it acquires to buy in assets, then that's an inflow. So the outflow has been matched by an inflow. As another example, suppose a U.S. exporter sells goods to a Japanese firm, and the Japanese firm pays for it by selling off some of its dollar assets. The export has produced an inflow to the United States, but the selling off of U.S. assets has produced an outflow. Again, the inflow equals the outflow. This equality of inflows and outflows is the same thing as the equality of debits and credits in any double entry accounting system. Because outflows equal inflows, the entire balance of payments is always going to be equal. That is, it's going to net out to zero. The balance of payments always balances. Subsets of the balance of payments can be negative or positive. For example, exports of goods can exceed imports of goods, or the current account can be in deficit or in surplus. But the remaining categories will be exactly equal and opposite to that, so the entire balance of payments is going to net out to zero. This equality of inflows and outflows is the same thing as the equality of debits and credits in double entry bookkeeping. This can perhaps be better understood by focusing on just the exports and imports of the current account. Suppose, for example, that imports exceed exports. If imports exceed exports, then a country is buying more from the rest of the world than it is selling to the rest of the world. In order to buy more than you sell, you must borrow from the rest of the world. There must be an inflow of funds on the financial account. The current account essentially reflects changes in indebtedness of a nation. If, for example, the current account is greater than zero, we are selling more to the rest of the world than we are buying from them, then we must be lending to the rest of the world. The financial account is going to have to be negative, equal to the current account being positive. If the current account is negative, like imports exceeding exports, then we must borrow from the rest of the world. We are increasing our indebtedness to the rest of the world.